Okay, so welcome you all back to day 2 of Ideate Innovate VC Symposium. We're going to kick off with Carta, followed by the London Stock Exchange. Our moderator today would be Tony Abrahams, who is the CFO, co-founder, managing partner of Relentless Venture Partners. And we have Andrew Brown from Carta, who's going to talk about all their resources, which are super critical to launching a fund. One of the reasons why, I looked at Carta and sort of tapped them for this panel was because they're doing some innovative stuff in fund administration that I don't think most people know what's going on. So you have to learn about it. I'm going to hand this conversation over to Tony and to Andrew, and I'll be right back. Tony?
Andrew, all right, thank you. Take it away. Yes, thank you, Boris, and good afternoon, everybody. I'm Tony Abrahams. I am the CFO for Relentless Venture Partners. I've spent well over a decade in the venture capital and private equity community in the capacity of a CFO. So with 2 particular fund groups, I've been involved with probably about 6 or 7 fundraisings, assets under management totaling about $1 billion in aggregate. And so I've been at it a minute. And one of the things that I've learned is that as new fund managers come to the marketplace, they put their deal teams together, they have their strategies and thesis, and they have their background. But really behind it all is when you launch a fund is you have to manage an investment company. And the fund administration part is the often misunderstood, overlooked aspect of really managing a stellar platform. And so that's what we're going to talk to you today about, is the importance and some of the critical things about it. And so I'm here with, so that's my background. I'm here with Andrew Brown with Carta. Andrew, please give us a little thumbnail on who you are and Carta, please.
Thanks, Tony, and good afternoon, and great to meet everybody. So I'm Andrew Brown. I've been at Carta now for just about 4.5 years. I started my career at a traditional fund admin shop that you guys may have heard of called VMS Fund Administration. Joined there, honestly, right out of college as a young staff person, and honestly didn't even know what a VC fund was when I did join there. But was there about 9 years, helped them scale from about 7 people upwards to 45, and about 30 or so VC funds when I joined to well over 300. I got super lucky, super fortunate in my career that I work with firms like Union Square Ventures, Lear Media, Softtech, now Encore Capital, IA Ventures, and First Round Cap. So I got super lucky to start working with those kind of firms and watching them build into the juggernauts that we know them today. And as I was learning and as I was building, I was starting to develop this rhythm of being able to help other emerging managers during that time, just based on my findings. But to make a long story short, as we were scaling up to about 300 or so funds at VMS, my ability to help those clients at that level was not scaling with me. Right? And I was losing an identity and I hated it. So I personally reached out to Carta, basically sent the email over to Henry Morales and basically talked about launching a fund admin unit here from scratch, right, at Carta. Back then, super simple philosophy. Let's apply a ton of VC automation to fund administration, right? With that automation, myself, my team, we can go back and start helping clients differently, right? More high level stuff and get more into the weeds with them. So made that official for the first 3 years of my career at Carta. And then beginning of last year, I decided I wanted to go back to what I was truly passionate about. And that was solely working with emerging managers. So I created what we do, what we call the pre-close team. And our whole journey today is basically helping clients from a signed contract at Carta to your first cap call. And you guys will soon learn all the craziness in between there. We want to be a guiding light and a resource to just try to help think through those things. So that's me. That's what I'm up to.
Awesome. And Carta is a phenomenal fund administrative set of solutions. But so we're all emerging managers here. And so I want to talk about the emerging manager process. So Andrew, one of the things that managers don't pay attention to is like the totality of all that's needed to launch a fund. So maybe you can just, shed some light on that. Help us, what can you share with us around what we need to consider, first of all, when you're launching a fund?
Yeah, I think the best way to do this, I'm going to share my screen, everybody, and just kind of show like a visual of kind of things we need to think about as we're getting ready to go. Give me 1 second to share this, and let me present. So this is a little cheat sheet that I put together. And guys, there's a lot of words on here, and I promise you, we're going to send this out as a repository so you guys have this later on, but I'm going to highlight some of the higher items here. So to think about things in blue here, we've got a lot of documentation to get through, right? We've got to create a whole set of legal documents that are institutional grade that LPs won't get nervous seeing. We've got to do compliance related stuff, Delaware, whatever state you guys are working on, the SEC, right? We've got to think about that stuff. Financial planning, right? We can't talk to LPs if we don't have a plan. Right. So we've got to think about budgeting, construction on the portfolio, schedules of capital call, maybe even we're going to utilize a line of credit. Once we get some of that stuff, marketing is huge, right? We're not going to have a fund unless we market. So we've got to build marketing decks. We've got, they need to have bios. Sometimes PPMs are relevant, term sheets, data rooms. Of course, you guys are branding, are going to need a logo. Third parties. So we've got to connect some of the dots. So if Carta is going to help with a ton of stuff, which I'm going to show you in a second, but we still may need to bolt on legal counsel and banking, audit, tax. D&O is director and officer insurance, and then potentially management company bookkeeping solutions, if not Carta. We got to set up bank accounts for all entities. We got to think about our software stack. Right? These are just examples of potential software that we could bring on, not mission critical, but definitely SaaS products that we'll need. And if you have employees, we've got to think about how to build the employee infrastructure and making sure they have what they need. So as I go to the next slide here, you got the same bullet points here, and you've got the everything shaded in gray is actually something that Carta is working on to basically facilitate in our own unique fund formation offering, which is inclusive of an advisory piece of it, where myself and my team will basically spend one-on-one time with our clients and help them think through these things, right? So you'll see everything here in gray is all part of, or more or less, our fund formation offering. All right, and then you have a couple things here in this other shade. And what I want to note there is we don't do them directly, but we're here to help, right? Connecting you with third parties, helping you figure out the bank account solutions, being here to help with payroll systems or maybe employee benefits and talk through that stuff. So Carta is creating an encompassing solution to basically help with as much things as we can.
So all right, that's amazing. And by the way, everybody, so we're gonna go, I'm gonna, kind of have a dialogue with Andrew and throw out questions to Andrew. You should be thinking about your questions, pop them into the comments, and we'll try to get some of your questions answered in this process as well. And so that's a great summary. And at the top of your chart, Andrew, is where everybody tends to go to first. You're going to start talking to investors, having preliminary conversations. And you're going to quickly learn that we're going to say, do you have your documents ready? Do you have your LPA, your PPM, all those types of fund agreement documents. And so you're going to go off and explore that. And that is your first bottleneck, because that process can be very daunting and incredibly expensive, right? When you talk to lawyers and stuff, some estimates can range up to hundreds of thousands of dollars when you think about that process. So Andrew, what are some of the things that you see, the workarounds that you're finding? How are people doing? I can tell you, for us, we were fortunate through Boris having a connection with a fund tax attorney who actually does fund agreements for a living. And so he's part of our team, he's our general counsel, and he was able to provide our documents, and that was our workaround. But Andrew, what are some of the workarounds you guys see, and what does Carta offer for that?
Yeah, I'd say like some of the old school method, and sometimes what we end up running into is people are basically bolting on multiple parties to complete an ecosystem, right? Where we can try to limit it. So basically bolting on a traditional legal firm to help you basically start getting the ball rolling on these sales documents, like the term sheet, the LPA docs like that. And that's going to start running a tab very, very quickly. We see other fund admin shops helping with some of the solutions, right? Helping you think through the modeling. So you basically have to work with legal team and fund admin teams to start getting the ball rolling in there, and then thinking about how to bolt on the tax side of things, making sure the LPs are comfortable that you have a reputable solution there. So lots of basically third parties coming in together, which is giving you a bespoke offering, right? It's traditionally bespoke. So what Carta is trying to do, and you saw from the screen that I shared, is we're trying to basically take our offering and consolidate it. So you more or less have a one-stop shop for everything that we could think about doing, right? And that is in the pre-phase of just getting set up and started, where you work with my pre-close team in terms of the fund formation and advisory services, which is just one-on-one consultation related work. And then as you get into the fund admin, you start to get into our actual Carta.com product and basically all the other workflows in there and industry grade tools that institutional investors are already very comfortable with, along with high net worth and family offices. Almost everybody that's investing in this space has seen Carta before. So I think Carta is basically doing its best to basically be a one-stop shop. So as you guys log into Carta, or as you're talking to the Carta team, it makes it very centralized, very easy than many bespoke humans out there or firms out there.
And later, I assume you'll talk more about that offering in more detail?
Yeah, towards the end of this, I'm going to go through a deep dive of what our fund formation product looks like step by step and make it as clear as I can.
Yeah, and I think what you'll find is that it's helpful in helping you, get through that initial bottleneck, which is the mind-blowing legal costs and documentation costs of pulling all this stuff together. So economics is an important part of fundraising. So let's talk about some of the first close economics, timelines, the amount. Like, what are you seeing with respect to first close economics?
Yeah, this is a great question, right? And everybody's a little bit different, but I constantly ask this. So when I think about dollar amounts, right, regardless of the fund size that you guys are looking to obtain, I like to push people to get to around a 20% target first close, right? So if you're doing a $10 million fund, I'd love to see $2 million committed, in a sense, to basically get our first close, right? And my rationale behind that is because most of the documents that are put together, whether they're Cartas or competitors, is you're basically getting a year to fundraise, right? So getting 2 million should get you enough to work to give you basically a runway to get to 8 million, the additional 8 towards the end of that 1 year shelf life. So anything above 20%, I look at icing on the cake in a sense, right? Just not good stuff to have in a sense. Anything below that, we would want to have a strategic conversation and talk about the risks of us basically not being able to get to targets. At 20%, you should be able to make your first couple investments at the right dollar amount, right? So you're not investing in something too small where it doesn't move the needle at the end of the day, right? Timelines are sometimes all over the place, right? So Carta tries to break down the timelines where you can more or less jump in with us first and make it really easy to basically spend a year with us and not get charged an enormous amount of money. But I think most fundraising to get to the first close, I'm seeing a quarter plus to get to that, right?
A quarter of a million.
No, quarter in terms of like a quarter of time, 3 months.
Okay, 3 months.
Yeah.
Okay.
Yeah. So 3 to 6, and so I'm going to say quarter to 2 quarters, 3 to 6 months. I typically see emerging managers as they march to their first close, right? And then the second close, and so on. Typically does, I see, honestly take a year.
Wow, I feel like we've missed our mark there.
It's a process, man. It's a process.
It's a process. So if you don't make it in a quarter, don't give up. Sometimes it can take a while just to build a network of investors and stuff. So appreciate that. So along that journey of fundraising and putting together your legal documents and beginning your outreach, there's this question of accredited investors versus non-accredited investors, the so-called 506B and 506C alternatives. You want to talk about that, Andrew?
Sure. So first, I'll just talk about what 506B versus 506C is. So 506B is basically a registration with the SEC in a sense, right? And it's an election. So basically what that election is the tried and true, very traditional election that basically says you can raise a venture fund and you could bring in accredited investors, right? Accredited investors at the baseline are people that make around $200,000, $250,000 a year and have some kind of assets under their belt to basically invest. But you could only work within your network or your network of one in a sense. If somebody's making warm introductions, that's totally okay. What 506C does is basically make it public, right? So you can use your social networks like Twitter or LinkedIn or Facebook or whatever guys you use to market and talk to a broader audience, right? And basically shoot that information out. The drawback, now it's super exciting to do that. We've done tons of funds doing it. The drawback is we need to do a further accreditation test, right? So if you're basically soliciting to somebody that you don't know, we need to double check to make sure they actually are accredited. So we use firms like, if you've ever heard of verifyinvestor.com, very easy, very user-friendly, prices are almost minimal, right? They'll actually do a verification check of their assets and make sure that in fact they are accredited. And that's what needs to be done for 506C. 506B, you don't need to do that. People will self-accreditate as they fill out their subscription documents to you. Okay.
Yeah, and I can say that in all the investment funds that I've done, which have been 7 raises at least, we've always chosen the approach where people would self-accreditate. I don't ever recall, doing a search on the investors. Well, that's great. So the next thing then, so let's see where we are now. So we've gotten to the legal documentation, we formed our team, we built our strategy, we've kind of made a decision on how we want to go to the market. And one of the questions that often gets asked is, what are you doing? How much are you committing to this deal as a fund manager, right? So what are you seeing in the landscape of GP commitments?
Yeah, another great question that we hear a lot. One of the scariest things is you guys are building this thing is like, how much skin can I put in the game and how much can I feel comfortable with, right? In terms of your own means. So the most common that we typically see is a GP putting up 1% of total committed capital. That is the most common. Now, I'm not going to say it has to be that way, because I've seen anything more is, again, icing on the cake. Anything less could invoke questions from potential LPs to say, why are you not willing to put more into the game, in a sense? So one of the things, sometimes 1% is a tough pill to swallow. I understand that completely, right? I transparently can put 1% into a lot of these things, right? So what there is a mechanism that is called cashless capital that you may have heard of. Cashless capital is a super cool mechanism, as cool as a legal term could be, right? Where basically it helps offset some of that capital that you would put into the fund. So let me talk about high level kind of what that means. Let's just say your commitment was $1 to the fund, 1%, right? $10 for a $100 fund, right? What we would do is run a 20-80 cashless capital split, which means 20% or 20 cents would be due over the capital call schedule, right? So if I call 5%, you pay 5% of 20 cents. In a sense, okay? The additional 80 cents, 80%, would be an offset to future management fees, right? And we would do that offset over a period of time, typically your investment period. So what that would mean, that 80 cents, let's just say it's 20 cents over 4 years, your management fee is $2, now it's $1.80, right? So what we're doing, in fact, is we're reducing your income, right? Reducing your income is actually a good thing, right? So reducing your income, but we're still fulfilling your committed capital. Now, here's the beauty of it. The best piece about cashless capital is it basically takes ordinary income, which you guys are probably taxed at a higher rates, and it moves it to long-term capital gains, which is a more favorable and better tax treatment for high net worth individuals. So basically what that means is that 80 cents that you lost in management fees, you'll get that back in the waterfall. As your investments start to liquidate, you'll actually get that back, right? So putting 1% in something we could always model out together, putting in the 1% using a cashless capital mechanism makes it an easier pill to swallow.
Yeah, and
guys, can I ask a question as someone who isn't a CFO or a brilliant financial engineer, just so I could, right set for everyone here? So what I'm understanding is, if I don't have all of that 1%, the cashless capital sort of allows me to get this done by taking cash from the management fees. So the management fees is ordinary income, from what I recall, correct?
Correct.
Okay, and the tax rate on that is the normal high income tax rate, right?
Correct.
We're fund managers, so like part of why we're fund managers is to be taxed at carry tax rates, right?
Capital gain tax rates.
Capital gain tax rates. There we go. I love when Tony corrects. He's he's gonna be scoring me here. Okay, so then this new income will come back to us in the future as capital gain, right? So that way we're actually paying the capital gain tax and not the ordinary income tax.
Right. So you're deferring. It's kind of a really interesting thing, because you actually defer your management fee. So you're foregoing your cashless portion of your management fee to make your contribution, your 1%. But when you start having distributions on the sale of transactions, you get a priority distribution for that management fee back to you. And that comes back to you in the form of a capital gain. So you're deferring, or you're doing away with ordinary income when you would collect the management fee, and then later with the sale of an investment and distributions, you actually get that management fee back in the form of capital gain income. So you defer it and improve the tax treatment, and you cover your 1% capital. And LPs are willing to accept this approach as a widely used mechanism for early fund managers, emerging fund managers to actually fund their GP commitment.
Okay, guys, if you have questions about this, send it to me in an email later, and we'll follow up with Tony and Andrew. We could probably put something together just to
and I can
explain the
tell
accounting.
you that.
But it's really simple, believe it or not.
Well, it used to be really complicated because you had to manage it by hand. So if you're managing it by hand, in Excel, it's work. It requires a lot of detailed analysis and understanding to actually model it out. And I've done that in the past, but Carter's solution actually facilitates it and makes it much more easier to manage. And so typically I would not advise a cashless approach for a small fund, say sub 50 million, but with a platform like Carter is something that I would consider using a cashless contribution model, because their platform actually makes it easier to do. So that's what I would, that's my plug for Carter, because I do think that, it's a way we have to find ways to meet that hurdle, because LPs still want you to be invested in the opportunity, right? And the more you can make your deal look less hairy, normalize GP commitment, reasonable management fee step downs, reasonable carry percentages and all those kind of things. The more your deal looks like a traditional deal, then the less hair is on it. Then it's about who you are and how good is your investment team and can you get this done, right? Take away all the reasons for LPs to say no, right?
But crystal clear.
Yeah. So let's move on then. So you're out here in the market trying to raise capital, and one of the things that LPs look for is your ability to source deals, right? And so part of your story has to be how well you can source deals. And nothing shows better than that than a pipeline of deals that you have ready to go, right? And so what do you do when you have found an entrepreneur, they like your story, they know you don't have your funds yet, but you think this is a great investment opportunity, right? And so, Andrew, what are some of the things that you're seeing investors, emerging managers do to kind of try to move the deal along as they're fundraising?
Yeah, another great question. So this is that you guys may have heard the term warehousing, right? You may have heard that thrown around since this is kind of what we're leading into, right? Warehousing is a great thing to do, right? Because any asset that you consummate via warehousing solution is something you can market, right? And the more things you can market, the better it's going to be and the easier your conversations will be, especially if the company is doing well and hitting milestones. So warehousing can be done in multiple different fashions, right? One of the hardest ones, but easiest ones technically to do, if any one of you guys or your close team have the means themselves, you guys can literally just buy the asset, right? And then basically at the time of the venture fund's first close, we can move that asset into the venture fund by just changing the cap table and making sure you guys are either reimbursed by cash or have an offset to contributed capital. That's the easiest way to do it, but obviously the hardest in terms of having the means to do it. The next level that we could think about doing this is through a special purpose vehicle, like an SPV that we've heard of plenty of times, right? And basically what we could do there is we could source a couple LPs, maybe one, maybe multiple LPs, and bring this deal into an SPV, right? And maybe giving those LPs some specialized treatment, maybe no carry on the deal, maybe something special on the venture fund side of things, right? Any mechanics there, right? But basically getting a pool together to bring it into an SPV. And again, that SPV at the time of the first close can be liquidated completely and have that asset moved into the venture fund at cost, or the SPV can live on and just take a piece of it out and bring it into the venture fund. So it's up to kind of the negotiations and the LPs that you talk to. But having those conversations for Fund 1 and even Fund 2 are incredibly powerful as you're looking to market and give people specialized deal flow.
Yeah, and it's a great thing because, the challenge that you got to keep in mind is that, it's hard to find an LP to sponsor your deal. Right? But there are firms out there that actually do warehousing. So you can look for those firms. I don't have any off the top of my head, but you can look for and do research and find firms that as part of their business model, they actually will consider warehousing your, 1 or 2 deals for you.
Actually,
So,
Andrew, that would be a great product addition to Carta. But no, seriously, like it's like one of these good boy like industries. Like you don't sort of know who's warehousing or why they do it, right, or how they do it. So
Yeah.
just FYI.
No, and I promise that you and the group that I'm going to bring this up to our partnership team and talk through it.
So now we're well into the deal, the fundraising process, and we've kind of gotten some deals looked at. We figured out how we're going to get our documents together, and we just want to create incentives for LPs to just take a bite, right? It's hard. Like they'll take a look, they start liking you, they take meetings, and the dance can go on and on and on. Like they're trying to ask themselves, is this person for real? Like, can this person really manage, a $50 million fund? Can this person really manage $100 million or whatever the number is? Can this team really manage it? Right. And so they're looking. That's why, fund administration is really important, because it's part of the professionalization of the organization and understanding this part of the experience. But you still, so you start thinking like, how can I create incentives? So Andrew, what incentives have you seen in this process?
Yeah, this is always a tricky conversation. So I'm going to lay out kind of the incentives in terms of what I think is best to worst, but everybody's situation is different. In my opinion, the best incentives that we can do for prospective LPs is what I just said earlier on the warehousing stuff. Give them access to some proprietary deal flow. Right? Let them enter an SPV. Let them get a little small chunk of the cap table, however we can do it, right? Because that's really like, you're going to know, I guess you guys will learn as you continue to source and sell your fund. A lot of LPs want access to you because they want access to your deal flow, right? So leading in and giving them some of that access is a nice way to basically say, well, it's like, I'm willing to give you a piece of it, right? The next side of things is future deal flow. Right. So basically, as you guys continue to invest, you guys, your investments hopefully will go on to raise series A's and B's and things like that may be too expensive for the venture fund. So allocating a piece of that to some of these LPs could be very beneficial, right? Again, they are in it for the deal flow most likely. So for them to be able to put a nice chunk of change in an A or a B or a C round, whatever it may be, could be great. Typically, that's done through a side letter. Right. But the LPAs that we build a lot of times give you discretionary ability to do that as you see fit, because as that A, B, C round is coming through, you may be a market for fund 2, maybe fund 3, right? And want to use that incentive to talk about new LPs that aren't on the tables. The next tier down, I don't love these options, but these are options that sometimes we need to pull the trigger on, is a reduction of management fees. Right? Let's just say we have a standard 2% management fee, and this LP comes in and you're going to give them 1.8, 1.7, 1.6, whatever the new amount is. That's okay, right? But sometimes at these smaller funds and just getting started, your management fee is important, right? You do need to operationalize, you do need to build, right? And what I truly think is giving them better access to deal flow will pay dividends for both of you guys in the grand scheme of things. But I do want to pull that out there as an option.
Yeah, can I comment on that for a second?
Sure.
So we've experienced that in the past. In our first fund, we actually did take a management fee reduction, now that I recall, and we took a 1.5% from the anchor, right? And when you have a side letter and you give somebody a preferential treatment, all the other investors want to have most favored nation status, right? So if you gave somebody else a special deal, they want that special deal too. And we had to say, no, their deal was different because they got you to the table. They came in first, they committed first, they believed in us first, they funded our first deal. They didn't wait for this first close process. So they did some things that no one else can do just because of time and circumstance. And so we were able to push back on that most favored nation. And so we completed our raise at 2%, but we were able to get that anchor investor in, and they had a 1.5% management fee, right? So sometimes you can negotiate that, and you just keep it with that one LP or two LPs that are actually kickstarting you with something as for consideration.
Yeah.
I'm sorry, Andrew, go ahead.
No, that was well said. And again, we would do that through a side letter. And for what it's worth, Carta has side letters like that as part of our offering. The next tier down is carry. Okay. The other thing that we potentially reduce is a discount on carry, right? It's typically 20% to the general partner. Maybe it's 18, 17 and a half, 15. I don't know what it is, but think about the long term of things. You guys crush it on the fund. You could have just cost yourself millions of dollars, right? On what that carry could be for a large LP. So it's one of my least favorite options to do, but doable. And my last option that I would push y'all not to do is giving out a piece of your management company, right? I do not like this option at all, but some big institutional investors try to get access to this. This is getting access to your brand, right? This owns your logo, your company, the future fund 2, fund 3, fund 4 stuff, right? So be very, very cautious about potentially giving up ownership in that management company. Maybe it makes sense, maybe it doesn't, but just be careful about that one.
Yeah, so and that last group is called seeders, right? They seed your fund, so they'll come in, they'll give you some early working capital so that you can kind of organize and do your legal docs and do other kind of things. And they'll actually invest, as part of your first close. And, and that investment is sort of sufficient enough to be an anchor to entice other investors to come through. So there are some benefits to that approach, and you just have to be careful how you negotiate their deal, right? Are they in the management company for just this one fund, or are they in it for life? Like, all those things, you got to pay attention to how you bring them in. And so, it is a legal cost to figure out and strategize and think through all the nuances of it, but it can be beneficial, and many successful funds got started with seeders, right? So while it is, got to give up. When they own a piece of your management company, they take a piece of your carry, they take a piece of your management fee, like they're in your economics. So you just got to keep that in mind. And that piece could be significant. It can be 20, 25% or something like that. So just keep all of that in mind, but it does get you started. So there's some trade-offs there to consider. So we're at the 35-minute mark of a 45-minute presentation. Boris, just checking in to see how the questions are stacking up in the digital world out there, and or should we continue here, or is there room for Q&A? What do you think?
No questions have come in so far. I've gotten some DMs that they love what's going on. So,
okay.
One new message. So why do people choose seeders versus the other two options?
Well, I'll answer that question. You tell me what you think, Andrew, or Boris even. But to me, it's a function of opportunity, right? So some people have relationships. You got an in with a large insurance company that's willing to be your anchor, or you're connected with some people who by brand name are able to kickstart your platform or something like that, and you don't need a seeder. But other people don't have those relationships, and so you might miss out on those opportunities. But it really is a function of like, how's the process going for you, your network, relationships, and so on. But before we start taking those questions from the field, we're going to pause. I'm going to give a few minutes for Andrew to talk a little bit more about Carta. And then, Boris, if it makes sense, we can hit some of the questions that may be popping up, or I got a couple more questions.
Yeah. We have another question here, but if we want Andrew to speak a little bit more about some of the Carta mechanics, we could do that.
Let's do Andrew. Let Andrew get in, and then we'll go back to some questions. Go ahead, Andrew.
All right, thank you. I'll go as quick as I can. But what I want to talk to everybody about, make sure you guys understand what Carta really does offer and what our fund formation journey looks like. Okay, so I'm going to walk through it. Our fund formation journey is meant to put customer service first, and the way that we think about doing that is making sure that we're doing weekly calls with each other to keep the project in shape, giving you guys an outlet to ask questions, or us to ask questions to you. So we try to aim to do a 6-week project. 6 weeks is incredibly aggressive, so we can go way further out than that, right? Week 1, as we start our journey together, we're just going to get to know each other a little bit, right? Going to ask you some questions about the fund, going to answer any questions you guys have about mechanics, just getting the ball rolling on timelines, just kind of get inside your head a little bit. After that first call, we're going to send you some data intake related stuff. We got to get to know you guys a little more intimately. So we're going to send you some data intake. It'll take you about 45 minutes or so to knock out. Once you knock that out, my team is going to be empowered to start formations for 3 legal entities. Okay, you are going to get a venture fund as a limited partnership, and then a management company and a GP entity as LLCs. Okay, they will all be in Delaware, and Carta will set up the registered agent as well. Okay, Carta covers all fees associated with this and ongoing as long as you are a Carta client. Okay, we are also before week 2 are going to be empowered to share the necessary set of legal documents that you will need to get the ball rolling. All right, I'm going to go through them really quickly. You are going to get a term sheet. Term sheet is a lightweight approach on your LPA to basically help share and socialize. Doc 2 is an initial LPA, short form LPA that you use to open up bank accounts. Doc 3 is your amended and restated LPA. This is basically the whole Bible of the fund, goes over everything about 60-page doc. It's LP facing. Doc number 4 is your subscription agreement. Another LP facing doc, goes over the fund a little bit, who to contact, and risk disclosures. Doc number 5 is called the investment management agreement. This is an agreement that links your venture fund to your management company. Think of it like a consulting agreement. Doc number 6 is called your general partner operating agreement. This has flavors to it where you guys could add advisors, you could add vesting schedules, things like that, just to make sure that we're getting everything we need for your brand. Doc number 7 is your management company operating agreement. This is more of a shell basic LLC agreement, just get that management company up and running, but it does have different schedules on how management fees work and how ownership works. And doc number 8 is a power of attorney with a legal firm called Winston & Strawn. Winston & Strawn is a firm that basically backs up Carta and all of our legal documents and our process. So I'll get into them in a second. Okay. Week 2 hits. We're on the phone. We're going to throw the term sheet on the screen. We'll go over term by term by term with you. Make sure you are super comfortable with everything that you see. Give you an outlet to ask any immediate questions. After that call, I'm going to give you all some homework. All right. I'm going to ask you to start reviewing some of the lighter weight docs and get the ball moving on that. Week 3, my team and myself, we put our CFO hat back on. We want to basically take that term sheet that you built and start doing some financial planning with it. So we have something called an operational planning model. So we'll take the terms and we'll start building management company budgets, venture fund budgets, portfolio construction, portfolio liquidation, waterfall analysis, GPLP, and a double click into GP. We're going to do cap call analysis. We'll do initial cap call planning, as they can be quirkier. And it's going to have other cool metrics like IRR, TVPI, and some other tips and tricks and cheat sheets in there. That is a living and breathing document. It's not going to be done on the 3rd week, but we'll continue to do that as we make progress together. All right. Come week 4, hoping at this point you're done reviewing the remainder of the documents. All right. If that is true, we're going to continue the operational planning model, answer any questions. Week 5, we're going to start 3 parallel processes. We're going to basically turn on Carta.com at this point, load your LPA, load your subdoc in there, and start blasting out this stuff to your prospects. All right. Making sure they're comfortable. We're going to call this the cat herding process. All right. Parallel path number 2 is banking. We've got to get bank accounts open for all 3 of these entities that we just created. Carta will help you with intros, help you with some of the paperwork if you need, but ultimately you guys and your team would be responsible to make sure the account is open. Parallel path number 3 is the regulatory filings that need to be done with Winston & Strawn. Winston & Strawn will take Carta's data to help process Form D, which will absolutely be necessary, and potentially an ADV filing, which is a filing with the SEC. It's not always necessary. It's depending on the state you work in and some of the size economics of that. Right. But either way, it's all covered through Winston & Strawn, who you guys will be able to ask questions to, and Carta will own the labor there as long as it's associated to those two requests. Let's flash forward to around week 6. Cat herding is in good shape. Bank accounts are open and the regulatory filings are done. You guys are going to log into Carta, you're going to flip a switch, and you're going to send the welcome blast out to your LPs, welcoming you into your venture fund. Right. Then my team is going to sit down with you and initiate that initial capital call. We've been working together for weeks. We know what you guys are thinking about in terms of the plan. Once that thing is initiated, we're going to introduce you to your fund administration team, right? Your pre-close journey is done. You guys are a live fund at this point. So you're going to meet your fund admin team, and your fund admin team will help you process that. The last piece of this is blue sky filings. Okay. We have to report to each state that you have an LP in and basically confirm to each state the dollar amount, right? Carta will again help you do that through Winston & Strawn. And you will not be limited to the amount of closings that you do. Now, the beauty about this offering is a $10,000 offering, and this $10,000 is due up front. However, it will be an offset to future fund administration fees. We will not bill you on fund admin until you do your first capital call. So basically, to get started with us, it's $10K, hit the ground running, and we don't bill you another $1 until you do your first close. And that way,
and you recoup the 10, and the 10K is recouped as a credit to future admin fees.
That's right.
So
that is comprehensive.
That is,
I actually think that's world class.
it's
I
game
gotta be honest.
changing.
I'm not. Listen, I've been going to a bunch of these new manager sort of conferences for all new venture managers, and you get to the point where we're talking about resources and consulting each other with resources. You got like all the the new young guys managing their $100 million funds, and
And
gals,
ladies.
by the way, and gals. Yes, I was about to say that. I was inclusive, and then on the other side you have the more mature people. And it's like, without a doubt, the new ladies and gentlemen are like, no, at Carta, value for dollar. And there's no other platform. So that everyone's just like, what's Carta doing differently? But this is a key example. And I think what's interesting, Andrew, about what you're doing, particularly, putting out call options on these new funds. I mean, you just don't know which ones are going to hit it big. So just like getting them on with
Right.
this low hurdle is just exceptional.
That's right.
Exceptional. Yeah.
That's right. We're looking for the next first round, next Union Square Ventures, and we're taking a shot on everybody.
Yeah, when you think about getting all that legal documentation and all of this hand-holding support through the process and all of the legal filings and so on and so forth, the prep and readiness that most people don't think about being handed to you like that for $10,000 just has just basically lowered the bar considerably for entry into this game. And that's why we got super excited about it. It doesn't replace the need for a lead finance executive in your organization. They still need to work with Carter's organization and stuff. So you still need to have a CFO or a senior finance person or whatever in your organization interfacing with Carta. The financial reporting, the LP reporting, all of that sort of stuff is your responsibility. And so I think, just as a good segue into another question. I don't know, do we have questions?
Yeah, we do.
Okay.
I want to see if Nika is available to ask her question. Nika, are you available to ask your question? I think I gave you the option to come off mute. If not, I'll ask.
Yeah, she's there. She's on the screen.
Hi, how are you?
Hi, Nika. Is it Nika or Neka?
It's Neka, but
Neka.
I appreciate the question. I feel like I worked at a fund who kind of like cobbled things together. At the beginning, they worked with a lawyer, have a different fund administrator who's not providing like a lot of options or resources. And I'm continuing to hear about Carta and asking like, why don't we have Carta? And I'm curious for folks who are in similar situations, whether it makes sense for folks that already have some of the stuff set up to transition to Carta, or is this just one of those things like it's set up, it's good, don't mess it up? So, obviously, you work for Carta, so your answer is.
I don't work for Carta. Andrew works for Carta. I don't work for Carta. So I'm actually with Relentless Venture Partners. I should have my background up like Boris so that I could, but let's be clear. You raise a very good question, and that's for internal deliberation. So you have to ask yourself, how much time, how much cost, how much efficiency or inefficiency are you experiencing with the process? Because I do think that Carta's solution will streamline a lot, right? And more of your time could be around analytics and portfolio management and stuff, which is why you need a finance person in your group to do some of the other more strategic value-added support, right? So they'll take care of some of the basic nuts and bolts that will free you to be more of a value-added contributor to the investment professionals if you're in that administrative side of the fund. So it's an internal consideration, but I know for a fact that when I was managing our funds with Excel through the journey, if Carta existed at that time, I definitely would have transitioned over, and I probably would have been able to get rid of a headcount or two that was supporting me. And if I brought somebody else in, they'd be more of a business analyst type who can help in more strategic ways around how do you manage the portfolios and how do you do due diligence and other kind of things.
Yeah, guys, and FYI, remember, Ideate Innovate is really about resources for new and emerging fund managers, right? So my wife actually works at a fund administration company. I'm not gonna say it's a really big one. And I know the executives there, the guy who runs, they're not doing this. The reason why they're not doing this is because they're not as, in our opinion, as innovative as Carta is in changing the dynamics of the game to sort of change who is allowed and who can play as a venture fund investor, right? Because what everyone else is doing, if you want a traditional fund, is not helping new fund managers launch their funds. So you know, we're not really trying to be salesy for Carta, but it just so happens that this is really competitive stuff. And when you look at someone like Tony, who has been an executive at a major accounting firm, he's been a CFO of several funds, and so in a Harvard MBA, and they're having him running fund operations, and Tony's like, I don't know, I could do all this by myself. I'm like, Tony, let's see Carta's offering. And he takes a look and he goes, oh my God, the game has changed, right? So that's why Carter's here, because the whole reason for our existence at Ideate Innovate is to have all other new fund managers sort of understand how to get up and running. So that's where we go. But thank you. I know we have another question for Evan. Unless Andrew, was there something you wanted to add?
No, nothing. I mean, Evan, your question at the bottom here is we'll make sure we get some marketing material out to the group as well. But. And
I think that is all that we have, unless I've missed something from someone. But apart from that, we could, unless you guys want to wrap it up, we could wrap up the Carta portion, the fund administration portion of this discussion. We could go to quit networking and come back for the London Stock Exchange. What do you guys want to do?
I'm here to do whatever the group wants. I can answer more questions, or we can network, whatever the group wants. So I'll leave that up to
Andrew. Thank you so much for coming today and for educating us on the process and business that is Carta Fund Administration. It was eye-opening. Every time I hear you talk about this stuff, I get blown away, and I learned more. So
it is very comprehensive. Listening to him go through their 6-week process, I'm like, wow.
And for those of you asking for the materials, we'll send it out. Hopefully I could touch base with Andrew and his team of Carta to see if we could put together smaller talking points on some of the more technical stuff that they that they have that they do around fund formation, the process, because the platform is pretty robust. Outside of that, Tony, would also like to thank you for for prepping and for putting this piece together and moderating so well. Having said that, I'm gonna break up the rooms here so we could start networking. Guys, remember, when we are coming out of the rooms, don't hit leave Zoom, just hit leave room, so that way we'll get you back here and you won't be kicked off of Zoom. So if you're fine with networking, just stay on and we will start networking now. Andrew, thank you. Tony, thank you. I'm gonna send everyone to breakout rooms.
All right, take care.
All righty. Breakout rooms starting. Let's see how many we're gonna have. London Stock Exchange is up next. And we should be